Thanks for joining us for this webinar as we take a moment to look back at notable developments impacting BDCs and registered closed-end funds this year, and look ahead to key regulatory trends as we head into 2024. For those that don't know me, I'm Steve Bohm, a partner at Eversheds Sutherland and head of our Capital Markets and Investments Practice Group. Today, I'm joined by my co-host, Executive Partner Cynthia Cruz, as well as several partners in our Capital Markets Group, Cindy B.A., Kristen Burns, Dwayne Dupree, Stephanie Hildebrandt, Ann Oberndorf, Owen Pinkerton, Paim Siadatpour, and Eric Simonek. Some housekeeping for today's webinar. Please feel free to use the Q&A functionality in Zoom to submit questions for any of our presenters. We'll try to address as many questions as we can throughout the session. This webinar will also be recorded, and you will receive a link to the recording following the session. Before we dive into today's conversation, I'm going to turn it over to my co-host, Cynthia, to say a few words.
Thanks for joining us here today. Our year-end webinars are always a helpful way to take stock of what happened this year. And there certainly have been a lot of activities and changes over the last 12 months. Direct lending has really come into its own. You almost can't open a newspaper without seeing an article on it. In addition, the SEC continues its robust rulemaking agenda with over 20 rules adopted so far this year and 15 proposed for next year. The pace has changed, has caused some concerns. There's been a real pushback from members of Congress and some of the courts. We also are looking forward to next year when the additional items will be coming up. During the webinar, we're going to look at how these various rulemakings are impacting the industry. We also want to look at what's going to happen in 2024. The SEC agenda outlines numerous rulemakings, including climate change, board diversity, and there's even some discussion around AI. I wanted to remind everyone to save the date for our upcoming 2024 BDC Roundtable, which will be held on September 17th and 18th in Washington, D.C. We look forward to moving the conference back to the fall session after several years of pandemic disruption. If you have any suggestions of things you'd like us to discuss, please let us know. Registration will be launched in the summer, and we hope to see everybody there. Okay, let's dive in. I'm going to kick it off with bringing on Owen to give us the lay of the land. Owen, what's happened with the industry in the past year?
Thanks, Cynthia. So despite all the regulatory items that you mentioned and all the SEC activity, there's been continued to be a tremendous interest in BDCs and registered closed-end funds. Just to start off with on the BDC side, this year we've seen 24 new BDCs file elections to be regulated as BDCs, and which is comparable to last year where we had 23. So it's a good number of new funds that we've seen. 18 this year are private. 6 are what we call non-traded. They're publicly registered non-traded. Last year was roughly the same. 17 were private. 6 were non-traded. So there's been continued to be a lot of interest in the structures. From a fundraising perspective, and just focusing on the non-traded for a second, this year to date, there's been almost $16 billion raised. That's through October by non-traded BDCs. There are 13 in the marketplace raising capital right now. 16 is a great number. It's not as high as it was last year, where there was almost 24 billion, but it is higher than the year before when we had a little bit over 14 billion. So still large amounts of capital that are being raised through that structure. The largest non-traded BDC out there is Blackstone's BCRED, has about 52 billion in total assets. And while that seems like a huge number, keep in mind that its sister REIT, the non-traded side, has about 135 billion in total assets. So there may be room for growth yet. One of the features of the non-traded is the 5% quarterly liquidity through tender offers, and we're seeing that really ramp up a lot, although not as much as we've seen in the tender offer and interval fund side. year to date, there have been about $2.7 billion in repurchases, which is about 20% of the capital that's been raised, which is a good, I think if you look at the percentage of repurchases versus capital raised with other structures, it's more like 30% or more. So we might see more repurchases in the coming years. A lot of the non-traded BDCs are really recently launched, but 20% is a decent number, and really it demonstrates that they're able to do what they say they're going to do, which is provide liquidity on a limited basis.
So we're on the right side of that percentage right now.
Yes.
And what about you mentioned interval funds? What kind of activity has occurred there?
So we're seeing the same sort of interest in interval funds. There are about 90 in the market right now. 50 of them have over $100 million in net assets. So they're all, I think a lot of times the break-even point is considered to be somewhere around 50 or so. So that there are at least 50 that are well above that. The largest is about 12 billion in net assets, maybe about 15 in total. As far as capital raise, it's very similar to the non-traded BDCs. We've got about 15.4 billion this year to date, and last year was about 23 billion. So those numbers are very, very similar. Repurchases for both years, we're looking at about a little bit over 7 billion. So for this year, it's over 40% of the capital raise. And that's what I was talking about before is, a lot of the interval funds have been in the market longer. So it's not surprising that there's more repurchase activity, but it's a pretty high number. So that's something to keep an eye on going forward. As far as the trends, AUM for interval funds is up 70% this year versus last year. And there are 23 interval fund and tender offer funds that are on the wirehouses now, which is up from 16. It's a pretty big development. You didn't see a lot of wire activity with unlisted closed-end funds in the past.
There's also the tender offer funds that have become more popular. Maybe you could spend a minute on that.
Yeah, so tender offer funds are very, very similar to the interval funds, except that they don't do daily pricing. They don't do daily sales. I'm sorry, daily pricing or daily NAV. And they tend to have much less liquid assets, just because they're primarily because they don't have assets that are really conducive to valuing on a daily basis, and so they use subscription agreements as opposed to having a ticker symbol. It's a primary difference. It's also not a requirement that they offer to repurchase shares every quarter, although most of them do. Almost all of them do. So there's a lot of activity in that market as well. There are about 90 in the market. 65 have over $100 million in net assets, the largest of which is around 14 billion. Asset classes you see in the tender offer space is really more real estate, private equity, infrastructure is a common, well, not common, but it's more, we're seeing more infrastructure funds now than we did in the past. So it's less liquid assets, but more of a focus on like real assets, I guess you could say.
Steve?
Thank you, Cynthia. And Owen, thank you very much. With that terrific scene setting, let's move on to capital raising. Stephanie, interest rates continue to be stubbornly high, although the recession many feared hasn't yet materialized. How have the economic headwinds impacted BDCs and other funds as they try to raise capital? And what are your predictions for next year?
I'm not sure anybody can predict what the markets are actually going to do in the coming year, but we can try. So first, as you mentioned, and everybody to see, and the debt markets remain expensive. Despite higher coupons, we've seen more activity in 2022. That said, aggregate proceeds still remain well below the highs of 2020 and 2021. While average yield on baby bonds seems to have decreased a bit in Q4, the average coupon remains above 8%. Speaking of the high volume in 2020 and 2021, many of these notes will be maturing over the next few years. So for a prediction, despite higher coupon rates, I suspect we'll see a bit more activity in the coming year in the debt markets generally, but also in the baby bond market because of these upcoming maturities. We've also seen an increase in private note issuances. We believe this shows more interest in BDCs by institutional investors, especially when offered registration rights for the private notes. While the average coupon is somewhat lower in these deals, it remains relatively high with an average of above 7%. However, so long as credit quality remains strong, we'll likely see more activity in the private note market, especially as the 2020 baby bonds get closer to maturity dates, as I mentioned. From an equity perspective, follow-on activity has remained fairly flat over the past few years, with only a handful of BDCs being able to access the public markets. That said, market prices are generally up from 2022 and certainly since the first half of 2023 and getting closer to NAV. If this trend continues, we hope to see more BDCs being able to access the capital markets in the coming year. In light of this and ongoing market volatility, at-the-market programs, or ATMs, continue to be a popular way to raise capital for public BDCs. ATMs allow BDCs to take advantage of market windows and pops in market prices, so they're ready to go whenever the window is there. In addition, we still see certain managers stepping in to cover sales load. That way, they can ensure that the BDCs are still receiving proceeds above NAV without worrying about the Section 16 restrictions. So what does all this mean? Despite rising market prices, continued volatility still makes it access to the public markets difficult for many BDCs. As a result, ATMs will remain popular for public BDCs, and we'll continue to see more platforms launch private BDCs, which I believe Kristen is going to be discussing a bit later. With baby bonds coming due, and because of the rise in private BDCs, certain liquidity options in those vehicles are also coming due, I suspect we'll see more activity in the capital markets, whether debt or equity, in the next 2 years than we've seen in the past prior 2 years. So with that, I'll turn it back over to Steve and Cynthia, unless they have further questions.
Great. So just to run through, we've also seen a little bit of an uptick again in the joint ventures as portfolio in order to increase portfolio yields. Dwayne, can you give us any background on the what's happening with the JV financings?
Sure, yeah, Cynthia, thank you. So what we've seen recently in JV financing is a couple of trends. One, we've seen increased economics for the BDCs. So historically, JVs have been 87.5% maximum economics to BDCs and the remaining 12.5% to the JV partner. Recently, we've seen that increase to a maximum of 90% economics to the BDC and then 10% to the JV partners over the last couple of years. So that's a recent change. Another trend with JVs is that the universe of JV partners appears to be expanding. So historically, JV partners typically have been large institutions like insurance companies, but more recently, we've seen domestic insurance companies, I should say also. More recently, we've seen JV partners that are foreign investors. We've seen JV partners that are large educational institutions. And we've also seen JV partners that are other investment managers that might not have the scale of their JV partner. So we've seen a lot more interest in JVs from non-traditional JV partners. Another thing that we've seen is new JV structures. So historically, JVs have been just simple LLCs with 50-50 management and sort of the economic split that I talked about earlier. Now we're seeing partnerships or tiered JV structures where it's a JV on top of a JV and other things like that. So I think that the JV structures are getting more complex. And with the final trend I'll talk about is multi-party third-party JVs. So you have several people several unrelated parties entering into a JV arrangement while maintaining that joint management structure and dividing the economics up differently. So a lot of interest has been in JVs and in these new structures, and we expect to see that continue with the continued hunt for yield. Steve?
Thanks, Dwayne. That was actually very interesting. A lot happening in that space. Kristen, private BDCs remain an incredibly popular option. What do you think is on the horizon for private BDCs in the year to come?
Thanks, Steve. At the end of 2022, we predicted that in 2023, private BDCs would remain an incredibly popular option, and we were correct. Since January, we've seen at least 18 new private BDC filings. Currently, private BDCs represent close to 50% of all BDCs and comprise about 35% of the BDC market based on AUM. As a quick reminder, and on a very high level, we use the term private BDCs to refer to all BDCs that are not conducting any sort of public equity offering. So they are offering shares through a private placement, which can either be through a drawdown capital structure or a continuous private offering. We usually consider the capital raising structure of these private BDCs to be one of their main advantages. It eliminates the cash drag you might see with an IPO because capital is either raised continuously month to month or in a capital call structure, where funds are only drawn as investment opportunities arise. Another advantage is a potentially shorter process with fewer regulatory filings because the Form 10, which is the main SEC filing, can be effective in as little as 60 days, and there is no need to deal with the stock exchange or blue sky filings. Historically, we have seen two private BDC structures. Initially, private BDCs were most commonly used as a stepping stone to a listed BDC. So in that structure, a management team raises money through the private BDC, builds up an initial portfolio, and then either conducts an IPO, which now does not have to be blind pool, or merges the private BDC into an existing public BDC. And then more recently, we've seen private BDCs used as permanently private vehicles, which means that they do not contemplate a liquidity event, but they do still have an end date. In this structure, the BDC is obligated to wind down after a set period of time, which can usually be extended subject to certain parameters, but there is no obligation to otherwise conduct a liquidity event. This structure basically combines the advantages of a traditional private fund with the transparency and oversight of an SEC-registered fund and the tax and structuring advantages of the BDC RIC structure. Most recently, this year, we've seen a third structure where private BDCs are used as a perpetually private vehicle, which is a private BDC that does not contemplate a traditional liquidity event and also does not have a set end date or wind down date. Instead, these BDCs intend to conduct quarterly repurchases, either shortly after commencing operations or at some point several years in the future. And they are often structured as a continuous offering with shares issued each month, rather than as a capital call drawdown structure. Of the 18 private BDCs started this year, well over half of them are structured to be perpetually private with quarterly repurchases at some point, and over half of those are structured to have a continuous offering structure. I think that for now, these perpetually private vehicles will remain popular, and we may see an uptick in the continuously offered private BDCs. This structure is combining the more streamlined private BDC registration process and the non-traded continuous offering process. Although the accredited investor requirements for a private offering are higher than the non-traded suitability requirements, the additional commitment amounts in a continuous offering are generally lower, potentially significantly so. And the perpetually private structure also has the benefit of not requiring the 50-state blue sky process, which is a definite advantage. One downside of the structure is that issuers will not be able to rely on exemptive relief to offer multiple share classes. Last year, we were hopeful that some issuers were about to receive this relief, but private multi-class BDCs appear to be off the table, at least for now. In addition to an increase in these continuously offered perpetually private BDCs, I think we're also going to start to see some of the original older private BDCs with defined liquidity dates start preparing to either extend their term, list, or pursue another liquidity event. At least one private BDC has made public filings in preparation for an IPO, and we would expect to see others this year as market conditions allow.
Thank you, Kristen. Now I want to talk a little bit about the SEC's 2024 examination priorities. They released these priorities back in October, and they continue to focus on valuation practices and investment companies. Dwayne, what are some of the trends that we've seen in compliance with the new rule that went into effect last year, the 2A5? And what are some of the best practices that we've been seeing in the new year?
Thank you, Cynthia. Just to back up, Rule 285 is the rule that allows the board to appoint the investment advisor as a valuation designee for purposes of meeting the valuation requirements under the 40 Act. So what we've seen over the past year is that most BDCs have in fact used the investment advisor to be the valuation designee. This is largely consistent with the practices that BDCs had before that. So for a lot of BDCs, this is not a large change. But we have found that some BDCs have not designated the valuation designee, the advisor as a valuation designee. And largely that is because those BDCs cannot do it. There's a segregation requirement in Rule 285 that says that if a portfolio manager can't effectively determine the valuations for the valuation designee. So if you aren't able to segregate the portfolio managers outside of the valuation process, then you aren't able to effectively designate the advisor as the valuation designee. This is common for some BDCs that are smaller or where people wear multiple hats. They weren't able to do that. So we have seen some issues around the segregation requirement for those BDCs, and those BDCs continue to have their boards determine the net asset value on a quarterly basis. Another thing that we've seen a trend in for boards that have designated the valuation designee, we see those boards continue to receive fulsome board information. One of the things that a question when this rule came into effect was what information would the board stop receiving? What information would the board continues to receive? I think boards have sort of used this as a transition period to get comfortable with the valuation process. So boards largely receive most of the information, 80 to 90% of the information that they received before. A lot of boards like to continue to receive that information, whether it's in an appendix or something like that. And then I think as the boards get more comfortable with the evaluation designee, they'll probably scale back on the amount of information that they see. But for now, we think that boards continue to like to see that information, and we've recommended that people, use this as a transition period. Another thing that we've seen, back to my earlier comment, was this segregation requirement. When you have the valuation designee and you have a valuation committee, who sits on that committee? And so there have been some struggles with defining who should be on that committee and who shouldn't be on that committee. The Rule 285 is principles based, so the SEC doesn't say, all it says is that the portfolio managers can't effectively determine the valuations. It doesn't say that they can't, people who are portfolio managers can't sit on the committee. So we've had questions come up with, well, should the portfolio managers be on these committees? Can they be on the committee, but in a non-voting capacity? Because they are reviewing they are the ones who are the closest to these assets, so they have a lot of information that they can share on the committee. So we've seen a lot of people struggle with that, and again, there's not really an answer. This is principles based, but you have to companies would be well advised to put themselves in a position where it's defensible if the SEC asks questions about who is voting on these particular committees. You have a rationale for the way it's structured the way it is. And the final thing that we trended out sort of touch on here is that the valuation designees, as a part of the rule, are in charge of monitoring the third-party valuation services. And so what we've seen is valuation designees asking those services for assurances and getting more like certifications and getting more in detail in what those third-party valuation services are doing. So we expect to see that this trend to increase. I like to call it like a mini 15C process for third-party valuation designee for third-party service providers. So we expect that since the valuation designee is in charge of this now, that those folks will be looking at those third-party service providers a lot harder than they may have in the past.
Thank you, Dwayne. Speaking of examinations, Payam, can you walk us through what you've been seeing in SEC exams this year? What should firms be on the lookout for?
Sure. So it's been a really busy year of SEC exams. Now, of course, SEC exams are nothing new. I can remember one of the first assignments I worked on was working on an SEC exam, but this year has been especially busy, both with respect to the number of our clients that were examined and also the extensive nature of the exams themselves. We've definitely seen consistency in terms of the issues that the staff is focused on. And just to highlight a few of the issues that we've seen consistently with every exam we work on this year, they include transactions with affiliates and potential violation of Section 57, the BDC's custody of its assets, various compliance-related findings under Rule 38A1, including adoption and adherence to applicable policies and procedures, allocation of expenses, investment activity by BDC and advisor personnel, and in particular, adhering to pre-clearance requirements, and finally, compliance with co-investment exemptive order conditions. So as I mentioned earlier, certainly all the exams that we've worked on this year have been thorough and they've been extensive. And in talking to other folks in the industry, that's been a consistent theme. But the good news is that in our experience, the exams have also been fair. If you run a good compliance program, you fully cooperate with the staff when they come in for the exam, and you demonstrate that you have a strong culture of compliance, you should have every expectation that you'll successfully get through the exam. The staff will almost inevitably identify issues, but you'll have an opportunity to address those issues in a response letter. And so far, again, the good news is that we're seeing the SEC is taking a reasonable view as it relates to any inadvertent compliance issues that they find. And as long as you appropriately address those issues, which will often include a commitment to the staff that you'll enhance existing policies and procedures to avoid similar issues going forward, again, we're finding exams are completing successfully. Now, Steve, to address your second question about what firms should be on the lookout for, luckily the SEC doesn't make us guess. Cynthia alluded to the SEC exam priorities list, which they put out in October, as they do every year. And so for the 2024 examination period, here are some of the items that they identified that we think will be most relevant for our BDC clients, and they included the following. The approval of the investment advisory agreements that the boards go through every year, basically a 15C process, disclosures to investors and the accuracy of filings to the SEC, the valuation policies and practices that Dwayne mentioned, in particular Rule 285, and clients that have designated the advisor as their valuation designee in particular, we think the SEC will likely focus on that in their exams for 2024. Derivatives, risk management, and liquidity and risk management programs, including compliance with Rule 18F4, and finally, again, compliance with co-investment exemptive order conditions.
Basically, the SEC is looking at everything, is I think the message.
Yeah.
Following up on that, in the SEC's examination priorities report, they also outlined their key areas of focus when it comes to investment advisors. What is the SEC looking for in the examination of advisors?
Sure. So, and one thing to note, when the BDC gets examined for externally managed BDCs, which is most of our clients, the advisor will usually be examined at the same time. So with respect to investment advisors, and the SEC, it included the list of priorities in their examination priorities list for 2024. They noted that they would focus on the advisor's adherence to their fiduciary duty to their clients. That is the duty of care and duty of loyalty. That's obviously pretty broad, but some of the specific things that they mentioned that we think will be relevant for BDC clients, that their advisors, that is their portfolio management processes, disclosures made to investors, in particular relating to expenses and allocation of expenses, again, personal trading activity and adherence to pre-clearance procedures and trading windows and the like, custody of assets, and then finally, the recently amended marketing rule under the Advisors Act. So those are some of the broad areas we think the SEC will focus on in 2024, which again is largely consistent with what we saw in 2023.
Thanks, Payam. Cynthia?
And now the most important person that everybody wants to hear about is Anne. And we're going to talk about co-investments. You already heard that Payam spoke about that in context of examinations, but Anne's going to run through some of the activity that has happened over the past year, and then what she expects for 2024.
With that lead in, I hope I don't disappoint you, Cynthia. To start, let's go with the numbers. About 20 new co-investment orders have been issued this year so far, which is on point with what we typically have seen in recent years. And then about 8 orders to amend a prior order were also issued so far this year. And that's compared to about 16 at this point last year. But that decline makes sense, and I'll talk about that in a minute. But I have to tell you, this is where it might be disappointing. There really has been no major news in the co-investment world this year. But I think there are 2 reasons for that. First, platforms are still excited about being able to use the process for amending existing orders to add the new definition of follow-on investment that was established last year and is still being used this year. And second, platforms are becoming focused on following established precedent rather than trying to make changes to precedent. So there's no really new news about that. So first, I think platforms are still taking advantage of last year's major development. As a reminder, I know I spoke about it last year, but last year, the temporary order issued by the SEC that created a new definition of follow-on investment expired. That new definition added the ability for follow-on investments for private funds that did not have investment in the issuer to participate in follow-ons, when previously they could not do that. So when the temporary order expired, all platforms with existing co-investment orders wanted to revise their applications to update the definition of follow-on investment in their order. So the SEC came up with a process to allow platforms to file applications to amend an existing order solely to update the definition of follow-on investment. And that was a faster process that everyone was appreciative of. And I think now all new applications that are filed new include the updated definition of follow-on investment. However, this year for existing orders, there are still applications being filed to amend an existing order solely to update the definition of follow-on investment. And those are the 8 orders to amend a prior order that I referenced earlier. And then that's compared to 16 that were issued last year. But I think that difference makes sense because last year this was new, so everyone was jumping on it. So while things have slowed down some, I think the numbers show that platforms are still focused on getting this change made through an order to amend an existing order. So that's been keeping people busy this year. Next year, I would expect to see even less filings made for applications to amend an existing order to change the definition of follow-on investment. And that's because platforms will at that point have had about 2 years to take advantage of the amendment process by then. Now, the other reason I think there was no major news in the co-investment world this year is that I think platforms are realizing that if they stick to established precedent, then their application can move through the review process faster. And I say established precedent because there are still a few variations of precedent out there. And depending on which precedent you rely on to start your draft of your application, you may receive additional questions from the staff. For example, there's a footnote that I spoke about at the roundtable, the last roundtable, and there are some variations in defined terms that are in some precedents, but not others. We have seen the SEC staff ask questions about concepts that are not included in the majority of precedent. That's not necessarily a bad thing. It's just another comment in your comment and response process. But if you're trying to obtain your order as quickly as possible, then you can strategize to potentially avoid that comment by choosing a specific precedent to follow. And for us at Eversheds, if we get a question on a comment letter for an application about a concept that is not in the majority of precedent, we typically have a call with the SEC staff if we're not quite sure what their concern is or how best to respond to the comment, because that can often help us avoid getting a follow-up comment, which saves us time and the SEC staff time and makes everyone happier. So those are the 2 reasons why I think we did not see much news for co-investments this year. The one thing I did see that Payam mentioned is that we saw that SEC exams are focused on compliance with co-investment order. And that just serves as an important reminder that everyone knows that you should make sure to have policies in place to ensure compliance with the conditions of your order, and more importantly, to make sure that you are following your policies. That's the most important thing. As far as what to expect for next year, it's hard to predict, and I would be happy to be pleasantly surprised, but I'm not expecting any major developments in co-investment applications next year either. And again, as I mentioned earlier, I think that's because I think platforms have gotten used to the idea that the process of making substantive changes to co-investment precedent takes time. And typically when a platform is applying for co-investment relief, they need to rely on that relief now. So they don't want to slow down the process by trying to make changes to precedent. So what we have been seeing and what we expect to continue seeing is that platforms are now following precedents, not making changes, but they're asking counsel for interpretive advice about questions that are not specifically addressed in applications. And as
excuse me, I'm sorry.
Keep going.
As I mentioned, I'm almost done. Don't worry, Steve. Platforms are also looking at precedent and focused on which one is best for them based on their specific facts. And I think they will continue doing that this year. And the last thing I would note is that I think the staff is still happy to talk about questions and proposed changes that people would like to see made to co-investment precedent. And so if a platform would like to see changes made to the co-investment precedent and give me something to report on next year, it may be helpful to call the staff first to talk through your proposed changes with them rather than just filing an application with your proposed changes. And now that is all I have.
There you go, Ann. I was just so excited during your presentation because nobody lives in the co-investment world like you've been there longer, you've suffered the consequences, and thank you for your presentation. We're glad at least you understand all the nuances. Cindy, the long-awaited amendments to the names rule goes into effect next week. Although I assume most on this webinar are aware of the amendments, can you give us a quick summary of the changes? And although the compliance date isn't until December 2025 for larger entities, what should funds be thinking about in the lead up to the compliance date?
Sure, thanks, Steve. Just to level set, when we say the names rule, we're referring to Rule 35D1 under the 1940 Act, which does apply to both registered investment companies and to BDCs. There are a number of components of the rule, but what we want to focus on, and what most people are focused on, is the general standard in the rule that basically says if a fund uses certain words in its name, that name is deemed to be misleading unless the fund has adopted a policy to invest 80% of its assets in the type of investments that's suggested by the name. So the names rule has actually been in effect since 2001. The version, I guess, current version that's still in effect until the new version goes effective on December 11th is, it includes words such as specific countries or industries or types of investments. The big change that was adopted is that sort of category of words has been broadened to include names that suggest that the fund focuses on investments that have or investments whose issuers have particular characteristics. Probably the easiest example to illustrate how this change, the change that just was adopted is, say, for example, a fund that has large cap growth in the name of the fund. Under the current version of the rule, that fund would need an 80% test related to its investment in large cap equity securities. Under the new version of the rule, the fund also needs an 80% test related to the word growth in the fund's name. So words growth, most of the talk about some of the words that are now included are around growth and value and how those are now being brought into the names rule. I'd also, always a hot topic of ESG. ESG words do fall in this latter category of particular characteristics. And so while there were the proposed rule amendments had some specific requirements for using ESG words in your name, the final rule amendments as adopted do not have those specific requirements, most likely because the ESG rule, the separate ESG rule for funds and advisors has not yet been adopted. That is still, it's still a proposal. And if that's adopted in the coming year or in the coming, 2 years prior to the compliance date, we may see some additional changes to, additional requirements for using ESG words in a fund name. And so Steve, you asked, again, you mentioned the 2025 compliance date, which actually, so given the December 11th effective date, gives larger fund complexes with over $1 billion in assets until December 11th, 2025 to comply. And then there's an additional 6 months for smaller complexes. That may seem like a lot of time, but there are likely some things people should start, funds should start thinking about, right now. If a fund does not currently have an 80% test, does the fund have words in its name that will necessitate adopting one? And even funds that already do have an 80% test, are there additional words that will now need to be covered by an amended test? And there are a number of things that should be looked at when thinking about this. Importantly, especially for BDCs and closed-end funds, is I think that the getting back into compliance period, which is 90 days. So the funds must look at their compliance with their 80% test on a quarterly basis. And if they realize that they're out of compliance, they have 90 days, only 90 days to get back into compliance, which, as you can imagine, for funds that hold a lot of illiquid securities or other liquid holdings could be very difficult. Another funds also should take a look at their any derivatives holdings that they might have. The rule has some very specific requirements about factoring in derivatives and exemptions for when it doesn't need to be factored into. That's sort of beyond the time I have allotted to talk about the names rule. But just in general, if you're a fund that's holding significant derivatives positions, you most likely will need to have those valued at the notional amount in order to determine compliance with their 80% test. So taking a look at those, and then just generally thinking about how an advisor defines the words in their name if they're subject to an 80% test. Are they, plain English or established industry use? And so those are just a very quick overview of some of the considerations. And, I mentioned that funds should start thinking about this now. And likely that is because there are probably going to be some funds that decide that they want to change their name, based on the amendments to the names rule. And obviously that's a complicated process. And in order to allow the advisors and the funds as much time as possible during the 2-year compliance window, looking at these things sooner rather than later is probably really important.
Thank you, Cindy. A follow-up question. For those in the audience that work with non-traded BDCs or closed-end funds, I believe there are some additional considerations. Can you tell us about those?
Sure. Yeah, no, definitely. So for mutual funds, ETFs, and listed BDCs and closed-end funds, those types of funds are able to amend their 80% policy by providing investors with 60 days notice. I think on the assumption that if an investor doesn't like the change that's being proposed, they have an easy way to get out of the fund. That is not going to be the case for non-traded BDCs and non-traded closed-end funds. Those funds will either need to get a shareholder vote to change their 80% test, or they will be able to conduct a tender offer with appropriate notice and following the requirements of the rule. And as long as that tender offer is not oversubscribed, they could then change their 80% test after that. So this is obviously a very significant consideration then for these types of funds in determining whether or not they need to have an 8% test and whether or not they can comply with it going forward. So, Steve.
Thank you, Cynthia. Cynthia, but Cindy. Cynthia?
Sure. And another new rule that actually was intended to go into effect more quickly over the summer, the SEC rules to expand the share repurchase disclosure went into effect. And Kristen, can you talk about those requirements and what the impact is going to be in the upcoming year?
Sure. Currently, under the current rules, issuers have to provide aggregated monthly share repurchase data in their quarterly periodic reports. And the new rules require daily share repurchase data, but it would be reported quarterly. And they also require qualitative information about the rationale behind any repurchase programs. This information will be reported in Form N-CSR for listed closed-end funds and Qs and Ks for operating companies and BDCs. Originally, the new rules required operating companies and BDCs to comply with the new requirements for their first periodic filing for the first full fiscal quarter that began after October 1st, which in most instances was going to be the Qs or Ks filed for the period ending December 31st of this year. And then listed closed-end funds would comply for the 6-month period after January 1st. However, in the end of October, the Fifth Circuit concluded that the SEC had failed to substantiate the rule's benefits adequately. In particular, the court stated that the primary benefit of easing investor uncertainty about motivations for buybacks was inadequately substantiated. The court gave the SEC 30 days to remedy these issues, but late last month, the SEC delayed the effectiveness of the new rules indefinitely. So while the timing is unclear, provided the rules remain in their current form, issuers will be required to report a fair bit of daily information. In addition to the date and the amount of shares repurchased and the average purchase price, issuers have to indicate if the repurchase was pursuant to a publicly announced repurchase plan, and if it was, the aggregate maximum number or amount of shares that may still be purchased pursuant to that plan. As well as indicating if the repurchase was in the open market intended to qualify for the Rule 10b-18 safe harbor, and if the issuer was trying to satisfy the 10b-5-1 affirmative defense conditions. In addition to this quantitative reporting, as I mentioned, issuers will have to disclose their objective or rationales for share repurchases and the process or criteria used to determine the amount of repurchase. They will also have to disclose any policies and procedures relating to repurchases and sales by an issuer's insiders during the issuer's repurchase program. There will be a checkbox requirement on Section 16 filings, which you will have to check if there were purchases or sales that are subject to the repurchase plan within 4 business days before or after the announcement of the plan. And issuers will also have to include in their quarterly disclosure information regarding the adoption or termination of any 10b5-1 trading plans. I think really the biggest impact on issuers is going to be making sure that they are operationally tracking this information and prepared to record it and report on it as required. And also to make sure that any repurchases they are making are consistent with the rationales and objectives that they've disclosed. So even though this information won't be required in filings for this upcoming quarter, we think that issuers should continue to prepare and capture the required information so that if the new rules do, or if the rules do go into effect and require this information, they're prepared to report on it.
Thank you, Kristen. Another major piece of SEC rulemaking introduced this year was the new cybersecurity rules. With compliance dates fast approaching, Eric, can you recap what new disclosure requirements the rules introduce and how firms should be preparing for them?
Yes, happy to. So over the summer, the SEC adopted cybersecurity rules impacting public companies that are subject to the reporting requirements, the 34 Act reporting requirements, including BDCs. So these rules create disclosure obligations related to material cybersecurity incidents, as well as obligations relating to public companies' sort of policies and procedures relating to cybersecurity matters. So with respect to the disclosure obligations, kind of two main categories of disclosure obligations. One is a obligation to promptly report cybersecurity incidents, and the disclosure should detail the nature, scope, timing, and impact of the incidents. And then the second category is disclosure of the of a company's kind of management and governance of cybersecurity risks. So with respect to the prompt, firstly, with respect to the prompt reporting requirement, there's new items added to Form 8K that require, again, prompt disclosure, which under 8K is generally considered to be 4 business days after the incident. Prompt disclosure of cybersecurity incidents, and the disclosure would have to include information about 1, the nature, scope, and timing of the incident, and then 2, the impact of the incident. And the impact should focus on the registrant's, the impact on the registrant's financial condition and its results of operations. Separately then, separate from the prompt disclosure requirement is an annual disclosure requirement that results from amendments to Reg SK that creates new disclosure requirements for 10K filings. And the new annual disclosure requirements include 1, a description of the registrant's policies and procedures for evaluating material cybersecurity risks. And so this would include a description of the registrant's policies and procedures for assessing, identifying, and managing cybersecurity threats. And then also the annual disclosure requirements relate to sort of corporate governance relating to cybersecurity risks. And so this would require disclosure of the role of the board of directors and management in cybersecurity risk management, including how the board of directors oversees cybersecurity risks and how the board is informed of the risks. And so those are kind of generally the requirements, the disclosure requirements of the cybersecurity rules. And as Steve mentioned, the compliance date is coming up. With respect to the annual disclosure requirements on Form 10K, the annual disclosure has to be made for fiscal years ending after December 15th, 2023. So starting, in this fiscal year ending any fiscal years ending December 31st of this year, the 10Ks would have to include this sort of disclosure of the management and oversight of cybersecurity risk. And for the 8K, the prompt cybersecurity incident disclosure requirements, that would include any incidents occurring on or after December 18th of this year. So again, that's coming up. And smaller reporting companies, the compliance date is 180 days after the other compliance date. So that would take us into June of next year. So, the compliance dates are coming up. And so what companies should be doing is kind of looking at their policies, procedures, and making sure that, they account for sort of oversight and reporting of cybersecurity matters. And so a couple categories for that should include, policies and procedures should demonstrate a clear process for determining the materiality of cybersecurity incidents. You should have kind of criteria to evaluate when determining the materiality of a cybersecurity incident that has to be reported on the Form 8K. Additionally, companies should start looking at should be looking at the policies, procedures related to, the role of the board of directors and management in overseeing cybersecurity risks, as well as evaluating the oversight and monitoring of third-party service providers. The SEC explicitly noted that cybersecurity incidents occurring at third-party service providers could, of course, impact the financial condition and results of and operations of a company. And so policies, procedures for the oversight of third-party service providers is going to be important for cybersecurity risks. And then again, policies companies should be assessing their processes for sort of internal communications of cybersecurity incidents in order to allow the prompt disclosure required by the Form 8K. Now, with respect to the policies and procedures, they should be clear about who's responsible for reporting and oversight. It's less important who is responsible and more important that the policies identify somebody as responsible for reporting and oversight. So in the coming year, last year in early 2022, as I noted, this cybersecurity rule relates to all 34 act reporting companies, including operating companies. Last year in 2022, there was a proposed rule relating specifically to investment advisors, investment companies, and BDCs. And the comment period closed in 2022, but then was reopened in the spring of 2023. So we'll have to see in the coming year what kind of rulemaking the SEC comes out with specifically related to investment advisors and investment companies and BDCs.
Thank you, Eric, and thanks to all of our presenters. This is about all the time we have today. As always, if you have any questions about any of the topics we discussed, please don't hesitate to reach out to any of today's speakers. Thank you all for joining us, and we wish you and your families a healthy and happy holiday season. Bye for now.